It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. The stock market has begun pricing in lower rates, of course. That was a big reason for the rally in the fourth quarter of last year. We're back with Colin Stewart. He's at JC Clark. He's our featured guest of the morning to talk about, Colin, how investors might want to be positioned as we expect rates to come down.
Yeah, exactly, Paul. So I think we're going to see in 24 really a reversal of some of the key trends from 23. We had last year, for a large part of the year, sort of very high inflation and rising interest rates and central banks raising rates. And I think this year, as you suggested, we're going to see, we've already seen inflation come down. Very likely we are going to see central banks start to cut rates. There's some debate as to, how much or how many cuts we're going to see. But I think the consensus is certainly that the short end of the curve is going to come down. And so I think that's going to see a reversal of, again, some of the trends from last year in individual stocks and sectors. Last year, many different companies, utilities, real estate, bond proxy type companies that are rate sensitive got really hurt as those rates rose. And I think this year, as they come down, some of those types of companies are going to benefit. So a couple areas we see in particular, one would be, high dividend yielding stocks. Those were really punished, particularly in the Canadian market, some of the banks, utilities, telcos, things like that. And then the other would be consolidators, or companies that are using, debt in some cases to roll up different industries and to acquire, businesses. And those, in many cases, were really hurt by rising rates last year, and we think they will benefit this year. So a couple individual examples of companies in that bucket of high dividend yielding stocks: Enbridge, an energy infrastructure company, very nice sort of 7.5% dividend yield, made a big acquisition last year. CIBC, we do have a position in a couple of the Canadian banks, and it's certainly one of the cheapest and was pretty beat up last year. We've seen a nice rally in the latter part of the year, and we certainly expect that to continue. And then Cogeco, one of the telcos that is really, or cable companies, I guess, that has been beat up and pays a pretty attractive sort of 5.5%, 6% dividend yield. So those are all the commonality is high dividend yielding stocks, pretty stable businesses. They were beat up and should benefit this year. And then on the consolidator side, two examples of, again, pretty steady companies that are rolling up their industries. One, Dental Corp, a consolidator of Canadian dental clinics that was really hurt last year. And then Park Lawn, which is a funeral home company or funeral and cemetery business that has a big position both in Canada and the U.S. Again, the stock was really beat up last year as it became, investors perceived it was going to be more expensive for them to make acquisitions. And now, hopefully, with rates coming down, they'll be able to get back out there and start that consolidation again with better economics.
Enbridge is, of course, a flagship dividend payer. The dividend yield now, a remarkable almost 7.5% on Enbridge. You don't think the market is expressing concern about dividend growth, the pace of dividend growth, are you?
No, I don't think so. And I mean, again, it has to be measured sort of relative to, when you see a company that, we think has a pretty stable business with that high a dividend yield, it would almost suggest that the market is worried about a dividend cut, which we certainly don't expect to happen. Right. But I think it has to be measured, again, in relation to the risk-free rate. So if we see, the risk-free rate come down on the short end, certainly this year, it's going to make Enbridge's 7.5% dividend yield, which on an absolute basis we think is attractive, look that much better relative to what someone might be able to get in bonds, for example, or in treasury bills. So I think, perhaps some, concern around them making a big acquisition last year and having to finance that, but they've already put a lot of those pieces in place, so we don't think that's going to be an issue, and we do like Enbridge here.
You like CIBC. Is this the year finally that the Canadian banks have a better year after two very lackluster years?
Yeah, I think so. And I mean, again, I would point to, important which specific banks you pick. And I think, again, CIBC had a really big rally. We were sort of buying it in the fourth quarter when it was down at $52. I think very good value. But even, it's run up here a little bit, but still on a price to earnings basis and a price to book, it would be, sort of among the cheapest Canadian banks. And I think as they sort of exhibit more stable performance, and there had been, I think a lot of concern with CIBC around their mortgage business. They have a big mortgage portfolio in Canada. And I think if we see rates come down and some stability in the housing market, and there isn't this sort of huge mortgage default cycle in Canada, that will give investors some confidence to sort of move back into CIBC. And I think, we don't see that happening. So I think they'll benefit as that concern sort of abates over the course of this year.
That's called